to guide you today through this seminar. We have the very good opportunity to welcome Jim Krane, who made to us all the way from the other side of the Atlantic, and he is going to give his presentation, but we will start with a presentation given by our own Indra Øverland. Those two are well-recognized experts on energy policy, and they will give us some insights into how new type of narrative shaping today's debate on energy policy, meaning first and foremost the focus, the huge focus on climate policy is going to influence our thinking and our actions about energy, but also they will also pay a special attention to the impact new technology may have on the future of a global energy system. We all as we sit here and with 7.5 billion other people living on this planet face something that is sometimes referred to as energy transition or energy transitions. It has something to do with the changing landscape of resources, but it also has something to do with new actors coming to market and changing the market itself as well. So we will now have the chance to listen to our two outstanding speakers who are somehow interested in the same topic, and both of them come also from the same place. They took their degrees at the University of Cambridge, and then Indra joined NUPI several years ago and has played a major part in establishing NUPI's energy research group, and he is still the head of this energy research group, and he has been involved in several energy-related projects, having focus both on kind of more global aspects of energy policy, but mostly having to do with developments in energy sector of our great neighbor Russia, that is also one of the big global and regional energy players. And his presentation that is going to focus on the impact of this debate on climate change and new technology and the emergence of shale gas resources and availability of shale gas and oil resources in the United States on the global energy market. And his presentation is going to be followed by a presentation by Jim Krane, who joined us coming from Rice University, where he has a position at the Baker Institute for Public Policy, and his main areas of research are global energy geopolitics, but he has also paid a lot of attention to how the ongoing technological revolution in the United States may impact on the energy policy of other types of actors, especially those who operate in the traditional area producing the bulk of energy in the Middle East. So we will have a kind of presentation on a broader context, and then Jim is going to narrow this discussion to the relationship between new technology in the United States and the responses other actors operating in the same market have embarked on in reaction to those new developments. So I think that it's time now to invite Indra to the roster, and he is going to start, and they will give those two presentations, and we will also have time to ask questions afterwards. Please, Indra, the floor is yours.
Okay. Thank you very much, Jakub, and welcome to Jim, coming over all the way, and with a considerable time difference. He arrived yesterday evening after delayed and changed flights and so on, and then we put him up in a very noisy hotel, so he hasn't slept either. And what we're going to do is I'm going to talk very generally and lay out some very general ideas about global geopolitics and energy and possible changes. And then Jim who actually knows something, is going to talk much more concretely and specifically about the Gulf and the Middle East and shale and relations with the US and whatever. And we both have way too many slides, but we've taken different approaches. Jim has his in a logical order, and mine are in a random order. So I'm going to try to talk over that. But we both need to hurry a little bit. Right. So if I'm speeding, now you know why. Lots of events over the last decades interpreted into a geopolitical worldview of competition over energy sources. And there's also been quite a boom in the industry that we're involved in analyzing and writing about geopolitics. And a bit of a cottage industry of, again, people like us and people perhaps not quite like us, who've made a lot of money talking about political competition over energy resources. And of course, the idea, at least until about a year ago, was that this was all driven by economic growth, especially in emerging economies. So we have, that's the blue graph here, the BRIC countries, and the fact that they were increasingly wanting to use the same oil that we want to use. So it's a worldview we've had for a while now of increasing competition over scarce resources. And the perspective that I want to present is different. So it's if that geopolitical perspective was a kind of a Malthusian perspective, in the sense of if you think of Malthus as the kind of the historical thinker who thought of the world as becoming overpopulated and resources as becoming depleted, leading to increasing conflict and competition. So I want to present, and Malthus's perspective is very compatible with the geopolitical perspective of the last decade or so. I want to present a different perspective, and not to say that resources aren't, these types of resources aren't non-renewable, because they are non-renewable, so obviously there are limited amounts of them, but to emphasize, or to start as one of my premises, that the amount of resources that we have access to and that we use is not fixed. Although it's fixed in itself, what we have access to depends on technology and it depends on costs, and both of these are facilitated by politics. So this is a dynamic picture where a lot can change. And in the rest of the presentation, I'm going to talk about two possible game changers first, and then about the possible consequences of these game changers for the petroleum sector. And the first one is unconventionals. And you'll see here quotation marks. And the reason I put unconventionals in quotation marks is that what is unconventionals at what time and one place is not necessarily unconventional in another time and another place. We could say that of a lot of things, but it also is true of energy technology. So when the North Sea was first developed, that was quite radical and new and risky and very expensive. Whereas nowadays, to develop a large field in the southern part of the North Sea is kind of a run-of-the-mill oil operation. And of course, so this is a very familiar story that I won't dwell on, the boom in shale gas production. And here, an interesting graph about UK natural gas reserves. And you see here the annual consumption. You see the conventional gas reserves. These are so small you almost can't see them, which is the point. But you see this red one here isn't much bigger than this blue one. You see onshore shale gas, loose estimate, and here a possible estimate of offshore shale gas. So how much gas the UK has, it depends on where you are here and what you think is going to be possible and economically viable to extract of this, which is a moving target. It changes. Okay, shale oil, slight lag, same story. Possibility for the future, gas hydrates. We know how to extract gas hydrates now. We could go and do it. And it has been done, but it costs a lot of money. But that could change, or it could not change. Who knows? Okay, number 2 is climate policy and new energy technologies, which in a sense are two different things, but one can drive the other, and the first has driven the other quite a lot already. Although we don't really have a global climate policy, there is a clear possibility that it could not happen, or that it could happen. And a dramatic boom in the capacity for generation of energy from renewable energy. And also here you see renewable energy in the EU, which is EU is obviously a kind of a grateful example because it's made a big effort in this area, going up here, and other energy types mostly going down. But then many would point out that solar power, for example, which you see here is orange, is there. You can't see it. It's so small. So yeah, there is a lot of growth. The growth is dramatic, but it's from a dramatically low base. So basically, we aren't using that much renewable energy as this graph could give the impression of. And then I'd like to modify that picture, like go back a little bit and modify that. So this is the share of different energy types. So you see, well, yeah, in China, basically the story is coal still. In the US, it looks like this. It's coal, natural gas, nuclear, and so on. With that graph too, sorry. Anyway, and here in the EU, you see that this is and this is specifically for energy, for electricity. You see that solar and wind are already playing quite a big role in the electricity sector. So it means that, yeah, it's kind of anything small here, but if this is anything if the EU is, as it hopes to be, a kind of some kind of example for the rest of the world, there may be quite big changes. And for the moment, we'll ignore the increasing consumption of coal in the EU, which is happening parallel with this. Another argument for why there may be surprises on the upside for other energy forms than fossil fuels is if we look back at the IEA and their forecasts, very much respected. Here's a forecast from 2004 in blue for wind, and here for PV. And the red are the realities. So we see the forecasts undershoot quite dramatically. Now you can say 2004 is a long time ago. So yeah, maybe there were some surprises between 2004 and 2010, but they may have caught up. But unfortunately for them, they didn't. They certainly didn't for a long time. So these are past forecasts from the IEA, from the World Energy Report, as far as I remember, and these are the forecasts for how solar and over here wind are going to develop over the coming years. So this is what they forecast in 2006. This is what they forecast for in 2008, 2009, 2010, 11, 12. So you see the forecasts keep getting adjusted up. They keep trying to catch up. And this is what has actually happened to 2015. So at least until 2012, which is the last report included here, they keep failing on the lower side. A little bit less dramatically for wind, but a similar story. And again here, a similar type of thing. This is not about the cumulative capacity of installed capacity, but this is about the annual installation. So how much is it expanding every year? And what you see here is that, again, the old forecasts from different period, but you see in 2012, even the starting point for the forecast is too low. So in 2012, reality is up here, but they're estimating that they're starting here and going here. How can you do that? Well, it's probably because they didn't have, the data weren't ready yet, I expect. Apart from, and in addition to having some bias. Right, so I hope I've made the point that things things may change. And I'm not saying that either of these scenarios, which are in a sense also contradictory, because one is about limiting fossil fuels and the other is about expanding fossil fuels, so it's unconventionals versus climate policy and renewable energy. I'm not saying that it's going to be like this or like that, and they are not really compatible with each other. But what I do think is that things change. And I think people inside, people outside peak oil enthusiasts often have been rightfully accused of underestimating the possibilities for technological change and how technological change changes the economics of the energy production. But many of the same people who make those arguments maybe also underestimate the possibilities for for similar types of changes outside of the petroleum sector. So change is a distinct possibility, and change is more likely than non-change, I would say, especially taking into account the very big investments made now in very, very many different types of technology. So if you look at past big technology shifts in the energy sector, and I guess we could say the steam engine running on coal, the explosion engine running on diesel, gasoline, and so on, and the electrical motor and nuclear power. If you think of the amount of scientists engaged in energy research in those days, a few handfuls in very few countries of any relevance, and the amount of research going on now across the world, in many parts of the world, in many countries which now have some scientific capacity and had zero when these other revolutions happened, there is a big potential for change in technologies in many different areas. So in the rest of the presentation, I shall talk about how the geopolitics of the world might change if oil and gas, for one or other reason, should become less important. So obvious should become less important or much more abundant, which is what the situation we're seeing the last 12 months. So first of all, on the abundant side is the possibility of a weakening of OPEC. Pretty obvious. And OPEC, that is to say some of the dominant countries in OPEC, the biggest producers with most flexibility, are currently trying to fight back against oversupply, and we have a bit of a shootout. But what the geopolitical consequences, if they fail, if they don't manage to get enough other producers to reduce their supply, a lot of these countries are going to be in for a rough ride, economically and politically. Many of these countries, and you see them, there are a few crazy oil importers who heavily subsidize oil, like India and China here. But apart from that, Iran, Saudi, Russia, Venezuela, Emirates, Iraq, Algeria, Mexico, and so on. There are a lot of big oil producers here who've been handing out oil for free, and one of the reasons why, or one perspective on why they do that, is that these are regimes, government states that don't have a very high capacity for governance, so they're not able to take the resources, turn them into money, and then turn the money into infrastructure and welfare goods for the population. So instead they do a very easy thing, which is just give them free fuel. But as they become more cash-strapped, that may become difficult, and there may be political changes in many of these countries. And it's interesting to see here, this is some of the big subsidizers, and here you see the how subsidies has also driven domestic consumption to the point where even very big producers or relatively large producers move towards a situation where they become net importers or have zero left for exports. And it's very interesting to see Egypt, how Egypt, which was once a reasonably important oil exporting country, and how its domestic consumption, the red line here, at one point crossed the blue line, which was the exports, which also fell. And I don't know exactly what year that is, but not many years after that, you had the beginning of the Arab Spring. Doesn't necessarily have to take place the same way all other countries, but it's an interesting example. And some of these really big, even a country like Saudi Arabia, could, in theory, in a not very, very distant future, end up not having enough oil for exports. I don't think that's a very likely scenario because they have a lot of things they can adjust, but it's interesting to see the wastage that's been driven by it. Okay. Here's just a quick kind of impression of who some of the big losers and gainers would be if there were less, either if there were more oversupply of oil, or a kind of extension of today's development, or if there were less demand because something else replaced it or repressed it. So obviously, Middle East is where a lot of it is coming, and the former Soviet Union is another big focused, West Africa too. So these countries have been gaining a lot and stand to lose a lot. And then on imports, US has been a big importer, but is already reducing its imports quite dramatically. EU and the rest of the world, which includes a large chunk of China and India in here. And Japan, as a lone country, is also pretty big. So all of these countries would gain from that kind of a scenario. And an interesting thing about how the world's use of oil and gas is distributed is that there are fewer big exporters than there are importers. So basically, there are some countries, not that few, but relatively few, and some of them making a lot of money by, in a sense, taxing or gaining through their trade balance in trade with all of the other countries. So everybody has been paying a tax to, all of these countries have been paying a tax to these countries, which includes our country. And if that changes, it means that it'll involve changes for the world economy, but at the political level and in terms of national economies, the changes are probably going to be more dramatic over here than over here. A country like Germany or Sweden is indirectly through the oil market to a country like less dominant aspect of their economies than it is of our economy. So the changes would be more dramatic for us as an oil importer. Another familiar graph, autumn of 2013, China takes over as the biggest net importer of oil in the world from the US, thanks to the shale oil and shale gas revolution. And what this means is that the current, or may mean, is that the current configuration of the Middle East with the US playing having a very strong military and political presence is out of sync with the greater dependency of China on the Middle East than that of the US. And the dependency is, in a sense, even greater than this picture shows, because US domestic production is bigger. So yeah, well, let's say here they're importing the same amount from the Middle East, but the US has more other oil. China is more dependent on this oil because its domestic production is smaller. This slightly tricky graph shows what are the important relationships. It's a bit like a social network. So who's buying from who in oil markets? And what we see is that, of course, it depends a little bit on how you classify these regions, but it still gives an interesting picture. So we see here Europe, and it's purplish blue, which is former Soviet Union, have the biggest oil trade relationship between two specific regions defined as these regions are defined. So that might, you could think that that would mean that any changes in the global oil system would particularly affect dependency there. But since oil is a global market, or in other terms, or put differently, since all the oil markets in the world are connected in one way or other globally, of course it wouldn't affect these individual interregional relationships so much because they could also get their oil from other places. So if Russia doesn't want to export oil to the EU, then the EU will buy more from Saudi Arabia or Venezuela or Norway or somewhere, and Russia will sell more to the old customers of those countries. Okay, pretty obvious. The other interesting, it's still interesting to see which the relationships are. Here is Japan, Middle East, big. China, Middle East, big. And another one, Europe, Canada, quiet, big, quiet. Europe, Middle East, USA, Middle East. Perhaps the most interesting thing about this graph is that USA turns up for the first time here on the 5th place. So although we would think, and to some extent it is true, that the geopolitics of the global geopolitics of oil, one of the main stories is the relationship between the US and the Middle East. Actually, a lot of the big trade relationships don't involve the US, they're between other regions. But most of those other regions aren't as active as the US. In a scenario of unconventionals expanding outside North America, which other people are better positioned to say than me how likely is, it's interesting to see who might some of the big winners be. So kind of a continuation of today's situation, but more based on what is now unconventional oil and might not be that in the future. And we see an interesting thing is that Russia, which already has some of the biggest reserves in the world and is most of the time the world's second biggest oil exporter in recent years, also has some of the biggest reserves. So it wouldn't be a dramatic change there. And also, they're unlikely to develop these reserves, although they're trying. They're not that likely to put a big effort into developing them before developing their more conventional and more easily accessible reserves. Especially as long as they're subject to sanctions against technology that could be used for these purposes. But more dramatically, or more interesting, there are countries like China, Argentina, Libya not, and Pakistan. So yeah, there are a few countries here which might, if the shale oil revolution were to spread to them, it might change their part in the world quite a lot. But a lot of the other countries like Russia, Libya, Australia, Venezuela, Australia to a limited extent, but Venezuela, Mexico, Canada are already very big oil producers. Okay. Another specific story, which could be a kind of a geopolitical story, which could be affected by changes, is the famous, infamous Russian-EU gas trade relationship. And what this graph shows is just the origin of EU gas imports. And we see that it's a little bit outdated because I only have data until 2013, but we see that it was declining. And Norway was eating in to some extent, along with Qatar and its new LNG capacity, which is of course not necessarily permanently fixed on Europe, but is a flexible option which can go there. But here for a couple of years the situation changed. I think that the situation now is Russia is going down again, and my hunch is that it may continue a kind of a wobbly downward curve. Because of the big European worries about energy security and the degree of conflict between the EU and Russia, which I think the conflict over Ukraine has reached a level where it can be self-reinforcing. So there are actors in Russia, in Ukraine, in the EU, in the US, who, for various reasons, have an interest in getting back at someone or criticizing someone or in continuing the conflict. And that, although we tend to forget or people tend to forget about it after a while, and the media lose interest, I think it has some capacity for self-continuation. So, and I think that's a negative for how this may develop. Right. However, it depends on the consciousness in the EU, because the EU isn't actually. It's very popular to quote this here, that Russia represents 40 or 50% or whatever of European gas imports. But then you can bandy around different numbers. You have the percentage of gas imports. You have the percentage of total gas consumption, which gives a much more moderate picture, maybe a third of consumption. And you also have the fact that these graphs, I'm afraid, have been swapped around, but that many of the countries which are most dependent are not Western European countries, but they are countries in the former East Bloc, and that used to be, up to and including 2009, used to be infrastructurally very dependent on Russian gas supplies, but where a lot has been done, including the expansion of capacity for reception of LNG and the building of interconnectors and new deals and agreements and so on, and the pushing back of Gazprom pressure and power. So Eastern Europe is less vulnerable than it used to be. And then a graph I think is very interesting, which shows the share, the kind of the final number, the share that Russian gas represents of EU total energy consumption. And what you see is that it is very stable between about 5 and 6, around 6% of total European energy consumption comes from Russian natural gas. Of course, gas can't be replaced immediately in short term with any other energy source, but it does show that overall, Europe is not really dramatically dependent on natural gas. And for Norway, it would be an advantage if people saw that, because one of the problems at the moment is that Russia's conflict with the Ukraine and with the EU is negative for the reputation of gas in general. We actually have an interest in a little bit less worry about Russia, just the same way as the Russians have an interest in us selling more gas to Europe, and maybe even in Qatar and Iran and Azerbaijan selling, because then they get a bigger, more diversified picture that where there is likely to be less worry about the Russian role. Okay. In saying what will happen, it's quite an obvious thing that if oil and gas supply and demand change dramatically, a lot of things will change in the world. Geopolitics will be influenced somehow. But what changes we expect depend on how we understand the geopolitics of today. And I think that is often a much more complicated question than it is assumed to be. So as an example of how one could think about this in a more complex way, I want to present my perspective of AAA analysis, which a few of you have been bothered with before. And the AAAs are, so they're triple multiple A's, you could say, in the sense that there are 3 A's and there are many of each of them. So it is actors, aims, and analysis. And if we think of the US invasion of Iraq, one of the kind of ideas that some people have about this, you could call it a conspiracy theory, but I don't think that's a bit too simplistic, I would say. But one of the arguments about it is that the U.S. invaded Iraq to get hold of Iraqi oil. Iraq has oil, therefore it's attractive, therefore there's geopolitical competition over it, therefore the U.S. went to Iraq. And if you apply a AAA analysis to this, I would say that the situation, even without doing any empirical work, I can almost guarantee the situation is a lot more complex. Because George Bush alone didn't take the decision to invade Iraq. Obviously, he's an important part of that, but the whole government, various actors in government and actors surrounding them and the broader elites and the media and various lobbyists and various interested parties of many different kinds, inside and outside the military and business and government, will have views about that and will influence a decision like that, especially in a country like the U.S., but even in a straightforward dictatorship, a more narrow type of political system, even then there would be different actors with different views, just making decisions about foreign policy. So some actors almost certainly thought Iraq has oil, we need oil, or we want more oil on the market to bring down prices in general, whatever. So we should go in and sort things out. And that would be, for example, actor 1, who has desire 1, I got mixed up here. Actor 2. So actor 2 desires cheap oil. So the aim is cheap oil, and believes that if the US goes into Iraq, it will achieve cheap oil. Will open the floodgates and all Iraqi oil will flow onto the global market. Now, we can imagine a different type of actor. For example, actor 1, who is not interested in, maybe genuinely not interested in oil, but genuinely wants to promote democracy or Christianity or whatever, and thinks that, yes, we should go into Iraq to achieve democracy, because we will achieve it and we want to achieve it. So a 5 and a 5 for each of them. And then we can think of a third type of actor, actor 3 over here, who thinks cheap oil, very undesirable, 1 out of 5. Are we likely to achieve it? No. So what is our analysis? Or our kind of key points are, what we aim for is expensive oil. And how will we achieve it? By going to war in Iraq. Now, if you want to be a conspiracy theorist, you'd say that these were the people who made the decision. And who are they? They're the friends of the Bush family, the oil companies, and so on. So if you want to have a conspiracy theory, you would say that that's how it works. But I think that conspiracy theory, although it's more convincing, happens to be more convincing in this case, is no more convincing than this conspiracy theory, which could be convincing in another case. And another important aspect of this view is that there are always unintended consequences. So nobody is totally in full control, but there are many different actors, and they have many different aims, and that's what drives the foreign and military behavior of states, which means that if you come with an understanding of geopolitics as this, like, three founders of a company fighting over the ownership of that company, 3 individuals with clear interests, I want a bigger share, which is the way I think geopolitics is often thought about, that's too simplistic. It's much more complicated. And that also means that if the global petroleum sector changes, and a lot of these benefits which some countries like ours has had, curses that some countries have had, burdens that other countries have had on their trade balances, yes, they will change, but how that will affect the geopolitics is a much more complicated question. It's also complicated because of the analysis side of this. So let's say the US involvement in the Gulf and in the Middle East is driven by oil. So if oil imports become important to the US, they will have less interest in the region. But will that lead to more war or less war? Well, it depends on how you see things now. Okay, thank you. I think we'll wait with questions until after Jim.
Yes, definitely. Thank you, Indra. You promised to get some attention with your slides, and it seems that you managed to achieve at least this goal, this desire of being looked at. Now I think that Jim Krane is going to provide us with another perspective, and I would also like to add two very small pieces of information. Towards the end of 2014, Norway has become the biggest gas exporter to the European Union, not least most probably to do those political turmoils. And I think that you rightly had some focus on technology, but I think also that another element that drives also to a very much extent the developments in the markets are prices, because this interest in renewable energy and this investment in renewable energy has also been to a very large extent driven by the very high price of fossil fuels, which made it much more economically viable to develop new forms. And this is also one of the elements in this Saudi strategy of getting rid of competition from shale gas, because they want to push the price of energy to below the level of economic durability for American shale gas producers. So I invite Jim now to give us this other perspective, and then we will have most probably have some like 15 minutes to ask questions after he's done with his presentation. The floor is yours. Thanks.
Well, thank you very much. I guess this microphone's working. I can hear it. I'll move ahead. Thanks, Indra, and to Nupi for having me. It's great to be here in Norway. This is the first time I'm here. It's been almost 24 hours that I've been here now, so very much enjoying it thus far. So I'm going to drill down into some aspects of Indra's presentation, and I've been reading his material, and he and I have actually been corresponding on some of this stuff for a few years, including back when I was doing my PhD. I'm a former journalist who left journalism while I was living in the Middle East. I spent a couple of years in Iraq and then about 4.5 years in the UAE, covering the Gulf and covering energy quite a bit, and then left to journalism for a number of reasons, but did some consulting for the government in Dubai, and then wrote my own book on it. And then went on to, when I sort of ran out of things to do, to get a PhD, and now I'm in sort of a think tank that's within academia. It's at Rice University in Houston, Texas. There's a think tank there called the Baker Institute, which is where I work. It was started by the former U.S. Secretary of State, James A. Baker, who's also a Houstonian. Including along with the former president that he served, the elder George H.W. Bush, who still lives in Houston and who once in a while turns up at where I work. So I try to wear a tie most days, just in case these guys are turning up in the office. George W. Bush lives also in Texas, but in Dallas, so he's not in Houston. Okay. So let's get into some of this here. I'm going to take you back to November 27th when OPEC met and the Saudi oil minister, Naimi, in a surprise or shocked a lot of the world of oil analysis by announcing that the Saudis were not going to cut oil production as many analysts expected. Instead, they were going to maintain their output, and prices, as we know, fell pretty steeply. They were already falling, and they fell pretty steeply afterwards, down more than 50% over about 6 months. So OPEC rejected this market balancing role that a lot of folks had assumed that they would maintain. OPEC didn't, or Naimi didn't seem to care whether markets were oversupplied or what happened to prices. He said it was really what they wanted to do was protect their market share in the face of non-OPEC production that was on the rise. Al-Naimi said that it made no economic sense for the low-cost producers to cut back. It should be the high-cost producers. So all eyes kind of turned towards the shale sector in the U.S. that had kind of sprung out of nowhere and was dumping all this extra crude into markets that were becoming oversupplied. So, we all know that the shale sector ramped up very quickly, and it was thought, including by me, that it could ramp down pretty quickly based on prices. The shale wells are affected by pretty quick decline rates. So it's almost like a manufacturing where you need this sort of steady rate of drilling to produce a steady flow of oil to maintain steady production. So if the rate of drilling falls off, it was assumed that the rate of production would soon follow. Now, as we now know, that didn't happen, at least not to the extent that the Saudis wanted. Now, part of the reason was it was sort of a short-lived revival, slight revival in oil prices between February and July. But probably the bigger reason is the efficiency of shale improved. So we had another technological improvement within a technological improvement, as Indra mentioned. And so I'll give you just some quick overview of what happened. Okay, so rigs are down, drilling rigs in the U.S., about 60% drop. Drilling didn't drop by quite as much. It dropped by about 50%. And an even smaller decrease in new incremental production that would come on stream in a given month. And that's not total production. That's just new production that would initiate in a given month. Is down by about a third. Okay, so what we had was producers abandoning their least productive real estate and just maintaining production in their what they call the tier 1 acreage. And then we had output per rig rising pretty quickly. I'll show you some charts on that. And we also had the break-even costs. The costs for producing oil in the U.S. dropped also very steeply. So a lot of trends kicked off by this drop in prices. And then I'll show you the U.S. is plateaued, and also this is total production, plateaued and is now beginning to fall. A lot of financial analysts believe that most of the shale acreage in the U.S. is not viable at prices of $40 or below. Okay, so I'm going to look at, so in order for me to come over here on Tuesday, I teach a class at Rice called Energy Policy, and on this Tuesday, I had to leave to jump on the flight, and a guy named Bobby Tudor, who's the CEO of an energy investment bank and research company called Tudor, Pickering and Holt, based in Houston, came and gave a guest lecture. He sent me his slides beforehand, and I managed to poach this one from his slide deck. It's a break-even analysis of shale at, this was the price when he made this slide probably a couple of weeks ago, $38. And you can see the various individual shale basins in the U.S. are just about none of them are viable at a $38 oil price. Only 2 are 100% viable, and there's 3 that would are mostly breaking even at that oil price. But at $60, you can see a lot of them are, okay? Now, I added this line to the graph from his talk in my class, his guest lecture in my class a year ago, when the oil price was really high, but just almost $104. You can see there's a sort of plenty of room for breaking even, and then some, okay? Here's a slide from last year that I managed to poach from his slide deck last year. You can see where, has this got a pointer on it? It does. Okay, so here's where the oil price was when he gave his talk last year, and all of these shale basins were breaking even, as well as producing, a 10% rate of return, at least. So you can see the cost basis has changed. So the oil price was bumping up. Some of the shale, some of the higher cost plays were bumping up against the oil price. And as the oil price fell down, you could see these things were, did they stop producing because the oil price was too high? Well, no, they got a lot more efficient, as this slide shows, okay? So their cost basis dropped. Okay, just a couple of, I'll just whip through these quick. This graph shows the drop in drilling, okay? So if you look from basically around December, there's a fall off in drilling. A lot of that was vertical drilling, the blue that fell off. And as I mentioned, less steep fall off in new production, incremental production that came on stream every month. You can see that the Bakken Formation, which is up in mainly North Dakota in the U.S., was the first one to really respond. You can see here's December, and then you can see it sort of right away in January coming down a little bit, and then continuing to fall, leveling off here. The Eagle Ford in South Texas didn't fall off as quickly. It kind of held on until March, and then we started seeing some slipping production there. Okay, but here's the overall picture of oil production in the U.S. So when Naimi made his speech, it was right here. So this is the the picture of production in the U.S. from the time Naimi decided not to cut production or told the world he wasn't going to. So that was about just under 9.1 million barrels a day was what we were producing in the U.S. You can see it continued to climb, and then it peaked. It sort of plateaued in the summer. There was a bit of a peak there, but it mostly just kind of plateaued up at about 9.6, and then it started to drop, okay? And here's where it is, where it was last week. These numbers are actually coming out today. I just been checking my computer, but they're not out yet. So we're going to see where today it should, I think it's probably going to drop some more. So but at 9.2 million barrels a day, we're still above where we were when Naimi gave that speech. So pretty stubborn. It's been a fairly stubborn phenomenon, but eventually coming down when the prices really shifted lower. And then just for the sake of giving you a little bit, a little more detail here, this is some data from the U.S. Department of Energy on drilling productivity. The top left is a nice illustration of the steep climb in rig productivity. So you can see the black line where rigs kind of just fell off a cliff here, like the price of oil. Look at that. Look at the steep climb in rig productivity. That's because these rigs were moving to more productive real estate. They were starting to use longer laterals and kind of cutting back on some of their expenses like service contracts and whatnot. So they got a lot more productive. On the top right, you can see how that the new production here in the Bakken has not increased enough to offset the fall off in existing production due to the decline rates. And then down here you can see that production in the Bakken overall has leveled off and now is starting to come down. Okay, here's the Eagle Ford Shale in South Texas. Same thing. It's also peaked and is starting to drop off in total terms. The Niobrara is a smaller shale formation. Same thing happening there. And then in the Permian, we haven't yet seen much of a drop. It's still looking like it's sort of hanging in there, but plateauing. Okay. All right. So let's turn back to Saudi Arabia. So a few years ago, what would have happened if the price of oil was falling? The Saudis probably would have gone ahead and done what folks expected of them. They probably would have twisted a few valves, taken some of that production offline, and forced the price back up. At least attempted to do that. They've done this a lot. They've got a long history of this. Famously in 74, 75, during the Arab oil embargo, They did it in 1998, in 2002, and they did it a couple of times during the big financial crisis in 2008 and 2009, but not this time. The Saudis wanted someone else to do this, as they mentioned, higher cost producers, and it looked like the shale producers in the U.S. were going to do that. So they certainly reduced their levels of activity. A lot of the rigs went into storage, for example, and they did this kind of on a collective basis on their own, really, without a cartel intervening or a regulatory agency sort of telling them to do this. It was these market signals that sort of triggered this idling of rigs and this sort of cut back in drilling. But these were market signals had been influenced by OPEC. Okay, it wasn't the OPEC actually telling them to do this. So shale. Shale certainly scaled back its activity levels, but the actual effect on its production has not been that great yet, anyway. Okay. What has also come about is probably many of you have heard that a lot of big projects that were on the drawing board have been cut back. Spending for new oil development has been cut back, and that will probably slow the flow of oil in the future. But it's not doing anything yet right now to stifle production from existing wells. So oil markets remain oversupplied, and the Saudi Monetary Authority has basically admitted as much in a recent report. It's been saying that that OPEC producers need to be patient in enduring low prices. That OPEC needs to be willing to maintain steady production until demand finally catches up with current supply levels. Now the U.S. could actually rebound. There's as many of you probably know, there's an ongoing discussion about lifting this ban on exports in the U.S. Sort of bizarrely, we have a ban on exporting one of the most tradable global commodities, and the political stars seem to be aligning for a lifting of that ban. So that could rekindle production in the U.S. It could raise, so the oil trades at a discount in the U.S. WTI trades at about a $6 discount to Brent. That could give the U.S. producers a little financial boost that they need. There's also China and Iran that are also sort of muddying waters for inconveniently for Saudi Arabia. So China's economy faltering. It has not yet sort of turned up in their demand for oil yet, but a lot of people think it could. And now Iran getting ready to sort of cast off its handcuffs and get back into the oil export business, with some more vigor. So the Saudis may be asking for even more patience coming up soon. Okay, so we'll have to see if events cooperate with them. So why did they do this? Why did the Saudis decide not to cut and just sort of keep the oil flowing? Well, they're certainly not automatons in Saudi Arabia, and the context within the oil market is one of the key signals that would tell them whether or not to cut. This time, I believe what Minister Naimi says, that the market share was the most important thing for them. It doesn't make sense for them to cut if another producer is going to fill in and just push more production out into markets, and then the price falls back. And then what's happened to Saudi Arabia is that they've just squandered their share of the market. And they also wanted to send some signals to that competition in terms of supply of oil, but also into investment in technology. So and there was this competition for markets as imports into the U.S., especially of light crudes, were being backed out. They were searching for other markets. That was competing with Saudi Arabia. So by maintaining production, the Saudis were not only defending their market share, but they were sort of using lower prices to kind of thwart some of those bad developments. Now, Saudi policy is driven by strategic considerations which probably trump the short-term economic motivations. Longer term, I think the Saudis would like to see someone else permanently take that swing supply role, especially when when it means that cutting production in Saudi Arabia. There are a number of very good reasons why the Saudis want to keep their oil production steady and at relatively high levels. These are just a few of them. The first one being they have a large and rising and unmet natural gas demand inside the kingdom. A lot of investments into petrochemicals, but also in electric power generation. Their power demand is growing by leaps and bounds. They're still meeting a lot of that by burning crude oil and other liquid fuels, and they'd like to get gas to substitute for oil in the domestic economy. Unfortunately for them, their natural gas production is associated gas. It only comes out of the ground when you produce oil. So if they're cutting back on their oil production, they're shooting themselves in the foot domestically because their gas production would also cut back. Now they're trying to fix that by exploring for non-associated gas, but they haven't gotten there yet. And they've also been making huge new investments in really big increases in their domestic refining capacity and also joint ventures overseas in refineries. So they've got 800,000 barrels a day of brand new, two really big refineries that need 800,000 barrels a day of crude oil. They've got another 400,000 barrel a day refinery under construction now. And so this basically kind of pins them into fixes their demand at a fixed level. And the same with their big petrochemical sector that they've already built. They need feedstocks for those industries, and being a swing producer, is not really compatible with these types of domestic ventures. Okay, so there's some pretty big downsides to what they're doing as well. So they're, of course, feeling some financial pain from this, as are all oil exporters, and Norway included. So the Saudis have acknowledged that they're going to be running a budget deficit this year and in the future. Other OPEC countries are probably going to be a little worse off, shifting into serious debt, borrowing abroad to finance their social programs. And some of the other so the poorer OPEC countries, ones with smaller resource bases relative to their population size, they might be starting to see some unrest breaking out, some political violence. If that spreads and if it looks like there's links to low oil price, the Saudis might come under some pressure to reconsider. And their current plan might look a bit more sketchy. But the sort of self-healing mechanism within the oil price, when there's political unrest, it gives the big oil exporting regimes a little bit of emergency help by increasing their revenues. Now the Saudis have been here before, and they've spent almost 20 years during times of low oil prices during the 80s and 90s, and they managed to survive, as did all the Gulf monarchies. The same families are running those countries today that were in the at the end of the Iranian Revolution in '79, when oil prices tanked and stayed low until pretty much unbroken period until 2003. So these countries are well schooled in the techniques for staying afloat, keeping their regimes in power. They do this by cutting capital spending and cutting big projects, by leaning on the private sector, especially foreign investors. And there's been a ton of foreign investment into that region in the past 10 years. They can start pushing some of their expenses onto those foreign investors through hiring quotas and through taxes and fees. They can cut subsidies, which is something that they, especially in Saudi Arabia, the new king has just said that's off the table. I'd say it's probably off the table for citizens, subsidies for folks that who are Saudi citizens. They probably won't get an increase in their electricity price in their homes anytime soon. But they can cut the diesel. They could raise the diesel price, cut the diesel subsidy in Saudi Arabia without any political fallout. I would think it's right now Saudi diesel fuel is being smuggled all over the Middle East because it's the cheapest by far. And then as a last resort, they can use repression, and all those countries have a pretty serious security apparatus. So things were tough during the last oil bust, but these regimes endured, and I suspect they're all pretty well financed and prepared for at least a couple of years of this. So some final thoughts. What does this does this mean a diminished role for shale? I mean, in the U.S., people were so hyped up on shale, and there were some really bold prognostications in Foreign Affairs and in some of the journals by some really key oil analysts in the U.S. who said, this was our shining moment, that we're finally going to vanquish OPEC and achieve oil independence, and it's not looking like that right now. My original thinking was that shale was going to be this nimble player, and that it was going to sort of rise, it was going to vacillate along with the market demands, that we were going to have this sort of just-in-time energy inventory, this efficient energy inventory, and that shale might help to protect against this another 2-decade oil bust by being this sort of supplier of last resort that could help meet market demand. But it looks like it's more stubborn and resilient than many of us suspected. The cost basis has dropped, production is steady. So how long can this go on? We're seeing it play out now. A lot of folks in the financial community argue that the shale sector in the U.S. is broken at these low prices, and it's going to be a matter of time if they stay low before these companies are swallowed up and production falls off. Now, I don't think Saudi Arabia and OPEC want to kill this shale sector. I think they'd like to see it take that swing supply role. I think they'd like to see it play what they might consider a constructive role in oil markets by adjusting production along with the demands of the market rather than shareholders. But I think in the shale sector in the U.S., this is not something they'd aspire to. It's sort of a cyclical, disruptive prospect, and it requires investment into infrastructure that they're not using 100% of the time. But regardless, someone is going to have to take over this role from the Saudis. The Saudis aren't just less willing to cut production now, but they are also consuming ever greater amounts of their own energy at home, and their spare capacity, the extra capacity they have when markets are tight, their ability to increase production is also dwindling. It's part of their it's part of their desire to diversify their economy and become this sort of a normal a normal type of country, one that's not just digging stuff up out of the ground and putting it on ships and sending it overseas. So this swing producer role that they've had has kind of held them back. It's been sort of buttonholing them as this primary product producer. But the problem for them is that their security relationship with the U.S. is predicated on them of maintaining this role. So the big problem for the Saudis is going to be reworking this oil for security paradigm, this oil for security relationship with the United States without squandering its hard security, its protection that comes from the U.S. security umbrella. And so that's going to be the big issue for them, I think. And they've taken some steps, I think, to do that, which I can talk about in the Q&A. But in the longer term, this is something that we're all going to have to watch and prepare for. Okay. And that's all I've got. Thanks for listening.
Thank you very much, Jim. I hope very much we still have some 20 minutes for Q&A session. One could also add one comment immediately after your presentation that we live in a kind of very paradoxical situation, because one could expect that with this turmoil going on in the Middle East, we should expect prices to be rather higher than lower, and then what we see is development that is contrary to this kind of traditional picture. So I'm very glad that we had both the chance to listen to Indra and to Jim, and I would like to invite Indra here to the podium, and please feel free to ask even most difficult questions. We have two persons here who should be well informed, and hope very much that they will be able to answer your questions. Thank you. The floor is yours. Yes?
Norwegian BI. Can I have that? Yeah. Thank you. First, let me say, I very much agree with Indra. We should have a non-Malthusian perspective. I think the end of oil has been predicted so many times that these predictions are not sustainable, to use that language. There's much more oil in the world than anybody thinks, and it will be the case, I think. That's very good. When it comes to what Saudi Arabia, together with the other key OPEC producers in the Gulf, that decided well ahead of the November meeting, the signals were very clear: do not expect us to cut. Most people who had some contacts with the OPEC headquarters, with the key countries, not with Caracas, but with Riyadh and so on, were aware of that. I think the Russians and the Iranians were also quite well aware that supplies were increasing more than demand. That is the recipe for a brutal price decline. And if it hadn't come by November last year, it would have come a bit later, would have had to cut and cut and cut and cut. So that's one thing. What is very important, and I think, Indra, in your perspective on the geopolitics, for the first time this spring, Russia was the largest supplier of oil to China, no longer the Middle East. That means that the old axis in the oil market between Saudi Arabia and the US, you just say what happens on the Saudi side, what happens to the US side, that the Saudi Arabia would respond as a swing producer to shifts in US demand, import needs to stabilize the market. Now we are in some way moving, it's not quite the same, but moving towards an axis between Beijing and Moscow in the oil market. China is by far the largest importer. It's going to remain so. But China has interest, not only, it has a very diversified oil import portfolio from African countries, even from Venezuela, and of course from the Middle East, from all of the major producers. That means that China increasingly will be able to centralize. The bargaining power is shifting to China, maybe a bit also to India and Japan, but essentially it's China. That means that Chinese are pushing with another thing, trading oil in yuan. They always start with Russia. Gazprom and Rosneft get paid in yuan, and they want to advance that with the Middle East. And of course, the crucial thing is, will they be able to force the Saudis to take payment in yuan, no longer in US dollars? That would be an earthquake of far larger proportions than the oil market. These are the things, and I think that's what we should look to. When it comes to the US, I think the US producers have no choice. The price realities, we are hardly, I think, unless there is a catastrophe in the Middle East, we're not going to see prices up to above $100 per barrel. There's so much competition, and we have got much more price elasticity on the supply side. That again could be a factor in stabilizing, because there are so many potential producers. That means that it will be far more difficult to coordinate. But that doesn't mean that the price will go down to $20 a barrel. Thank you.
For a comment and a question, maybe.
One question is very interesting, and I know Øystein has written about it before. Is one of the few people who've really talked about this, the role of the dollar and its possible displacement. And I would love to do some research on it myself. I haven't done it yet, but I'm thinking about it. And I think it's, I don't know. First of all, I'm not sure what the consequences exactly would be. I mean, at one level, it doesn't matter what currency you trade in because as long as other people are trading the other one, it just depends on the exchange rate. So they're just, when the Russians and the Chinese trade oil, they're trading it in, or they're using yuan for part of the trade. I don't think for all of it, but for part of it, mostly experimentally and talking about expanding it, they are still trading it in dollar prices. So the price is in dollars. But I guess what you're alluding to is that if this spreads, one day we could be talking about Brent oil in yuan as kind of the currency. But I think that's a long way off. And if you look at the situation at the moment, I would say that the US economy is resurgent. The dollar is resurgent, especially seen from an oil currency like the kroner. And the ruble is very weak, extremely weak at the moment. And I believe the yuan has just fallen a little bit in value too. There was this story about it when the sanctions against Russia started. There was a Russian politician, parliamentarian, or a state member of the State Duma, who wrote kind of in anger a protest against these evil sanctions. And he wrote, I will never buy an American product again. So we're going to get back at you. And the way he kind of communicated this message to the world was by sending it from his iPhone, tweeting it from his iPhone. So that's 2 American products. And for me, that kind of is an example of how, in terms of innovation and in terms of leadership, the US is at least as dominant now as it has been in the past. And I think it's going to be very difficult to displace the dollar for that reason, as the currency of trade.
What is your take? You have a kind of even more personal interest since you have dollar as the main currency you use. So, any idea about this?
Not on the currency issue. I mean, it's not something I've really looked at. I mean, I think there's some of the currency effects, the dropping, the strengthening dollar, and the dropping, some of the oil currencies dropping is working in those countries' favor. I mean, Russia is probably pretty happy that oil is traded in dollars right now rather than yuan. And I think Russia and some of the Middle Eastern countries, Russia might be the #1 supplier to China. China, is like you said, has a diversified source of supply. But the Middle Eastern countries, the Gulf countries, are very focused on Asia now. And, the U.S. One supplier is Canada by far. Saudi Arabia is managing to hang on in the U.S. because it exports heavy sour crude that our refining configurations require, and that's not something we produce in the U.S. So, but it is something that's coming increasingly from Canada. So Saudi Arabia and Canada are starting to have a bit of competition, in the U.S. Gulf of Mexico refining area there. Those 2 crudes are competing, but the Saudis maintain a pretty big toehold in the market in the U.S. because they own 50% share in the Motiva refining group. So the Saudi and Shell have a 50-50 joint venture and are very big, three really big refineries on the Gulf Coast. And so if you buy your gasoline in the U.S. from a Shell station, that is refined Saudi crude. And that's how one of the ways that as they as their role in being this sort of swing supplier in global markets starts to dwindle, that's one way that they can maintain dependence and the strategic interest of the United States is by remaining a large supplier and a big refiner in the U.S.
If I may add to this currency issue, I think there is also another side of the coin. If more oil should be traded in yuans, then China could face another challenge because most of the currency reserves are allocated to dollars. So how this would influence the kind of their economic situation. So I think the picture is much more complex, and we are still talking about relatively small volumes of oil to be traded in yuans.
Microphone.
They're building down their currency reserves in dollars. China is diversifying its holdings of foreign currency. They're reducing their dollar holdings. It's the Chinese who push for oil pricing in yuan. It's not my idea. The Chinese are behaving like that.
Well, it could be a nice hedge for countries like Iran that sometimes face the sanctions for their use of the dollar. I mean, if another country wants to hedge and is worried about running afoul, say Russia, of U.S. sanctions, that might be a nice hedge for them in the future.
I also wonder whether if you were a third country, or fourth, I guess in this case, would you want to trade in yuan? I mean, China is a one-party state, which is not very transparent. It's an increasingly important part of the economy, of the world economy. But do the Germans want to trade oil with Norway in yuan? I'm not so sure. I'm not so sure. And if anyone wanted to get away from the dollar, they would probably go for a basket. And I'm not even sure that basket would include yuan for a long time.
Yes, please.
Hi, Tina Saltvedt, Nordea Markets. We have 10 years with increasing oil prices, and that's for sure changed the supply side. Seeing a lot of new oil coming into the market. It's also changed the demand side radically, in my opinion, and together with the climate aspect, that might change the demand for the future as well. Do you think the move by Saudi Arabia or OPEC comes too late?
Good question. I'm not sure. I mean, so there's there's a lot of sort of decision making in developing countries that has come into play with a high oil price. So these countries like India and China have been developing under these assumption of potentially an assumption under high oil prices, and you start building out infrastructure that kind of makes you path dependent on a certain level of consumption. So China's been building its cities with high rises, with lots of mass transit, and maybe less reliance on automobiles, although that's probably also a function of just the pure density of those cities. But had oil prices been low like they were, in the decade prior to that, would China have made a different development choices, or would India have made different development choices? Would they have gone for a more energy intensive type of cityscape, or they may have. So potentially, yeah. I mean, you hear the old phrase, the best cure for high oil prices is high oil prices, right? So but there is a path dependence. So 10 years of high oil prices has certainly created these some fixed pathways that are now going to be tough to deviate from.
I agree with Jim. I think another interesting aspect of it is the long-term market psychological consequences of having had so expensive oil for such a long time. In that, I think many market actors got used to that in terms of the people who trade oil. It was always a burden on the budgets of using it, but the people trading oil got used to it. And I think that if you think of it in terms of a psychological barrier, I think that barrier has been moved up. So if, as I think is quite likely, in 1 or 2 years from now, the oil price bounces, I don't think it's going to bounce to $70, or I don't know, but it could easily bounce to $110, which would then just be back to the way it was. So in terms of the purely market psychology, that would make some sense, at least for a while. And I think that's quite likely to happen also because of the big cuts we're seeing. And I'm not an expert on shale oil, but I kind of expect there to be an impact. I think it's taking a while. And I was telling Jim has heard this already, but it's said that the world lives on oil, or is fueled by oil, and the oil industry is fueled by money. And I think for the lower oil prices to have an impact on the shale production or unconventional oil production, there's a lag in the impact on the financing. So if you're a bank lending to somebody, they were always running with a deficit, prospects were good, then the oil price fell, you thought it was going to rise, they're begging you for more money, you've already lent them a lot, so you don't want to kind of drive them into bankruptcy if it's not necessary. But then, at some point, after 6 months or 12 months or 18 months, so we're there 12, 18 months now, you're going to say, this doesn't look too good, you know, we need to clean this up. And so I expect to see more cuts, and I expect to see that driving a bounce in the price. And which then goes back to your question about, did they leave it too high too long? And I think yes, because they created a kind of a psychological level, which is, or a level that's psychologically kind of simple to move back to. And if it happens quite fast, which seems quite likely, that would further promote alternatives again. Because then the alternative people who are speculating the other way, thinking, should we invest in this alternative technology? There's a risk it may not work. There's a possibility we make a lot of money. The possibility starts looking big again. So they think, well, that was an intermezzo. Things look good. So I would say yes.
In the U.S., we're still waiting for this big sort of, binge of mergers and acquisitions, and it hasn't really started yet. So this is another thing that, hinges on your point that as these companies are more distressed and as banks start putting pressure on some of the weaker ones, one of the ways that the banks can be repaid is through, a buyout. Predicting this, but as you know, it hasn't really happened yet. So.
Are there any other questions? If not, yes, Roman, please.
My name is Roman Vakulchuk. I'm Senior Research Fellow here at NUPI. And my question is to Indra. You showed one interesting graph where you showed the rapid deployment of renewable energy in the form of solar and wind energy. And my question is, I have two questions. First is, would you say that high oil price over the last, say, 10 years was one of the factors which contributed to this very active and rapid development of renewable energy? And second question is, if the oil price remains low for the next 3 years, how do you think the graph would look like in terms of the, for example, solar and wind energy? What will be the impact of low oil prices on renewable energy?
So I don't have a very good question. I do think that the renewable energy has been promoted by the high oil price, but of course most of it isn't going directly into that sector. But I think what we've seen is actors. I think actors like Elon Musk with Tesla, and I think this is the city in the world where they sell most Teslas. There's a lot of them around here in some neighborhoods, and I think people like him. So he's not really even promoting renewable energy, but he's positioning himself for a more electricity or possibly hydrogen-dominated economy that will replace oil in the transport sector. And I think a lot of the people dealing with different aspects of renewable energy and other new energy technologies are doing similar positioning. So some people say, but renewables don't compete against oil. It's electricity production versus liquid fuels for the transport sector. But I think, yes, still there is a connection in the way they think about things. How a lower oil price, so logically, lower oil price should have some impact. But again, back to Tina's question, I think it's probably too late. I think the ball's already rolling. People have already seen that technological change can happen. And there is an idea that you have that the price of photovoltaic panels will develop in the same way as computer chips. So it's like an exponential change that will. So all these expectations are built in, which would motivate people to continue investing, I think. And especially when the oil price bounces.
If I could just add one quick comment too, that this is the renewables installation in the U.S. didn't stop in recent years. So yeah, it doesn't compete so much with oil; it competes with gas, and the price of gas has fallen through the floor. So you have this technological revolutions going on in the renewable space, but also in the in the oil and gas space, fracking made gas cheap, and it put a lot of pressure on renewables. And it's the renewable growth has managed to stay afloat and continue. I mean, I think this really acute competition with gas is also making it more efficient. So it's helping it as well.
Yes, please.
Hello, I just got a simple question for.
Can you present yourself?
Hello?
Can you present yourself?
Oh, my name is Trond Kuburi. I got a question for our American friend. You know, American politics are kind of full of inconsistencies, like the US being a champion of free trade and having a ban on oil exports. With that basis, could you imagine any possibility that we could have some kind of an institution functioning like the Texas Railroad Commission used to do some 4 decades ago?
So another regulatory agency that controls oil production. I think
that's exactly what they did to balance world markets.
That's right, yeah. So before OPEC, we had the Texas Railroad Commission that restricted U.S. production until the U.S. became a net importer, and then it no longer was needed, really. We still have the Texas Railroad Commission, bizarrely named, controlling, regulating somewhat or not in Texas. But no, I don't see another agency that is going to control U.S. output in the same way. I think it's going to be market signals, with the caveat being that we happen to have a ban on crude oil exports, but not on exports of products. Okay, so you know how that's playing out. I mean, for the others in the audience, we've got this restriction, this kind of binding constraint on oil exports. So oil produced in the U.S., by and large, has to be sold in the U.S. to U.S. refiners. That's, despite it being pretty high quality, very light crude, that would probably sell at a premium to Brent. It's selling at a discount to Brent. Refiners in the U.S. are capturing those rents. They're refining this crude, and then they can export it. So now the U.S. has become a net exporter of refined products, and those are being sold at world market prices. So the idea being, if we remove that ban, which is looking likely, you'd have this sort of bizarre situation where the price of oil, WTI, would rise, and all else constant, the price of gasoline might actually drop a little bit in the U.S. because given the extra supply on global markets, that could bring global oil prices down a little bit. So it's almost like a have your cake and eat it situation, at least in the short term in the U.S.
May I have a comment to the last?
Please.
Yeah.
Because if you do that, you will have a change in the market in the U.S. But the global market shouldn't change very much because the U.S. is importing.
Tiny.
So we're likely to have a reduction in import comparable to the exports from the U.S. So it will only be the refiners that will be able to have a gain from getting a better product mix for the present refiners in the U.S. So when people kind of think that this will have a significant impact on the global price, I can't understand that. A technical question. You said that the productivity of shale wells had improved. Did you mean that the production from each well is growing, or did you mean that the drilling time has been reduced?
Well, I don't know about the drilling time, but production per well has gone up because drillers have been focusing on the most prolific real estate, so the best geology that is you can produce from, as well as some of the laterals in these wells. They've been extending and working on extending them, sort of changing the mix of their frac fluids, other techniques, and also they've been reducing their labor costs. And service companies have been, getting their costs squeezed down. They've been forced to deal with less. So lots of efficiencies.
I think that we have to stop now, but Indra had also one question.
I have two questions
Oh, even
for
two.
Jim. And maybe Øystein would also like to comment on these questions. So, and it's kind of an extension, because Tina said, are the Saudis too late in lowering the prices to beat off the competition from other oil and other things, possibly? What I'm wondering is, one, there are all these, you hear all these things about what they're motivated by. Are they motivated by not only beating off shale oil, but also beating off other emerging energy sources, which you see developing? You see solar power companies winning contracts on market basis for long-term electricity supply in the United Arab Emirates, which is next door, and also similar things in Saudi Arabia itself. So they know what's going on, and is that part of what is driving them? That's one question. Is that one of it, or is it simple, or is it more simple and brutal? Just market share. We don't care. We just want to keep our market share. We don't want to be the swing. We don't want to swing downwards anymore, at least. That's the first question. And the second question is, Saudi Arabia has a lot of money, like Norway, saved up. And it seemed, the way it looked from the outside, and the way Øystein presented it, this was planned, people knew it, they did it, and it had an incredible effect. Maybe the effect was bigger than they expected in terms of the oil price, but the effect on shale was maybe smaller. So I don't know if the effect was bigger or smaller, but they did this thing, it had the effect. Did they position their savings for this? Because you would think that in Norway this would be considered unethical, I guess. But there are many things you could do in Saudi Arabia that you can't do in Norway, and vice versa. But I would think that if you sat on, I don't know how many $100 billion they have, and you knew that you were going to make the oil price fall, you would go short on kroners and rubles and stuff like that. You would get rid of a lot of you would print more money and buy other currencies while your own currency is high. You'd go short on some oil stocks. You'd go long on airlines and the like, big consumers of oil. Did they do that? So those are the two questions.
Well, the second one, I think you would have,
The easy ones, yeah.
you would have seen probably had they shorted and made a bunch of market moves like that, somebody would have noticed that. I mean, I don't think they would have gotten away with that, and then okay, we're not, I don't know. I think, but that's, I don't know. I mean, I can't say, but I think they would have probably signaled their hand before playing it, and you probably would have had market chaos. I think they're pretty disciplined, a bunch over there in energy policy. I mean, you rarely see Saudis contradicting one another, and they really march in lockstep. And when someone says something different, they're quickly on the record to contradict it and maintain a pretty strict party line. I can give you an example of one of the senior princes a couple of years ago said, "Oh, we're going to raise our theoretical production ceiling to 15 million barrels a day," Naimi quickly stepped in publicly and shot him down. Even though Naimi is, technically a commoner, and this was a senior prince, he had no compunction about telling him that wasn't going to happen. Now, privately, people in OPEC, I mean, in Aramco say, well, they may have to do that. If their economy can't be diversified quickly enough, they may have to raise that production ceiling. But that decision has definitely not been taken yet. On the sort of market share longer term, I think the Saudis are probably resigned to giving up some of their market share for crude and trying to capture more out of the crude oil value chain through products and refining. And manufacturing in the kingdom, so they can start building up a more diversified, more developed economy, and that this is probably the first signal that their economy is evolving. As far as their investments into solar and nuclear power, they're talking about as well. They haven't actually done any of those. They've been mostly speaking about it. I don't think that there's been any contracts or tenders released on that yet. The UAE has, okay, so the UAE is building 4 nuclear power plants. Of course, Iran has one. And the UAE has also installed some small amounts of solar generation. There's not a lot of wind in the Persian Gulf. There is on the Red Sea, there's some wind resource. But But I think when the Saudis were talking about solar, first of all, solar was seen as this panacea. There were so many Westerners talking about you guys should be developing solar. You've got so much sun. And then when they actually tried it, it didn't work as well as, for lots of reasons, it hasn't worked as well as a lot of people expected. It's been really expensive, and for the most part so far, really disappointing. I think that's going to change, and it'll improve. And there's been some bids, pretty low-cost solar bids for that we've seen coming out. When those conversations were happening, that was during a time of really high oil prices, and I think the Saudis were genuinely worried that global demand was getting beyond their control, and that they were going to need some help from some alternative energy sources. I mean, China was growing by leaps and bounds, so I think there was probably a genuine feeling that that market tightness, that growth was something they were stuck with, and they were probably getting worried. But that's just a personal feeling. I'm just don't have any evidence for that.
Øystein?
I think the Saudi concern is about future revenues. With a market share, there must be a market for their oil, and preferably a growing market. It can be put very succinctly: oil in the ground that doesn't sell has no value. This is what they have seen. So if they had to cut and cut and cut again, their oil in the ground would have no value. It's as simple. What, to your question about the money, this coincided with the death of King Abdullah. There's been a whole shift of personnel. Ali Naimi belongs to the old guard. He's still there, but he is on his way out. And we don't know who is going to come. It might be a royal. It might be Prince Abdulaziz. It might not be. The point is that this new crowd, if this had been under Abdullah, they would of course have cut budget, cut spending, military spending, everything, and they would hardly have embarked on a war in Yemen. He was a conservative, very cautious person. This new king reminds me of old King Fahd, who was fated to be. There are no Saudis in the room, I hope. And they are undisciplined, spending money. They made an enormous arms deal with the US recently. Not because they need the weapons, they need their personnel to run these weapons, but to have influence, have clout with the US arms industry, which they hope can have political influence beyond that on Congress and in the administration. They are spending much money. This is the thing to look at. They may have to wake up, say, the price of oil is 50. Kuwait has adapted. Kuwait has made its budget depend on a $45 oil price. The Emirates are following. That may be the case for Saudi Arabia, and that would be a wake-up for those who deliver goods and services to the Saudis. But that, I think, is the major concern. I've been there several times quite recently. The concern is future revenues. Thank you.
Thank you.
Which is not only Saudi's concern, because having this oil adventure in Norway going on for almost 40 years, we are also very preoccupied with this type of issues. So I think that on this note, I would put an end to this very interesting discussion, and I hope to see many of you again on another occasion. Thank you very much for two very interesting contributions, and thank you, you audience, for giving us some challenges when asking those very difficult questions. Thank you very much.
Thank you. Thank you.